Well, hello everyone, and thank you so much for attending my webinar on why your business isn't as profitable as you think. So today we're going to cover three main areas, which are common finance mistakes that could be costing you money, the red flags to watch out for in your finance function, and then the transformative role that a finance director could play in fixing some of these issues. So before we get started, I thought it'd be useful to go over some terminology. So first of all, the profit and loss account, which we'll be talking a lot about today, is basically a report which summarises the performance of the business over a fixed period of time. That typically is a year, but it could be quarterly, it could be monthly. The key thing is it's the performance over a set period. And we find that most businesses are reasonably good at monitoring this, normally on a monthly basis. The other two key reports to talk about are your balance sheet, which is essentially a snapshot of your company's assets and liabilities at a point in time. I did a webinar on this with one of our fractional finance directors, Ramsey, back in November. So I won't go into too much detail on this, but the main principle here is that many business owners don't actually look at the balance sheet as they should, and that can cause significant issues in terms of compliance and also the accuracy of your profit and loss account. And then the third key report that all finance functions should be producing is a cash flow forecast, which is different to a cash flow statement. So a cash flow statement is looking back. It's sort of a financial report that will look back at your cash movements over a period in time, whereas your cash flow forecast is actually a financial report which looks forward at cash incomings, cash receipts and cash outgoings, and that should give you a clear picture of your cash flow requirements of the business. I'll show an example of one later on in the webinar. But the key point here is that both the balance sheet and the cash flow forecasts are often reports which don't get looked at much by business owners, and they place a lot of reliance on the profit and loss account. And I'm going to go on to sort of demonstrate why just looking at the profit and loss account in isolation can be quite risky. So I guess the key sort of common finance mistakes that could be costing you money in your business is that real focus on the profit and loss account, no attention to the balance sheet, no cash flow forecast. So we demonstrated in our webinar on the balance sheet in November. Actually, you could be a profitable business, but if delays happen in terms of getting money in from your customers, then actually you can require funding just to sort of see you through, even if you are profitable. Again, I will show an example of this sort of towards the end of the webinar, so you can sort of recap on that. And many businesses that we come across don't have a budget in place, so you don't actually know what costs you should be incurring as you are passing through the months, which makes it very difficult to control what is actually going on in terms of the finances of your business. So here's an example of a typical profit and loss account, and as you can see, you've got sort of your actuals, which you believe that you've incurred in the year ended 31 December 2024 against the budget. And you can see actually that you've done reasonably well against the budget, and you've got an overall profit figure there at the end of the year. So on the face of it, this looks like quite a healthy P&L. However, on sort of further sort of analysis and inspection of the underlying records, a number of adjustments have come to light. And I'm going to talk through each one of these so that you can understand, how you can potentially spot these. Obviously, just examples, but how you can spot these different things that actually now ultimately cause your profit to become a loss for the year. And there's several factors that have impacted on that. And I'll just go through each one now so that you can sort of get a feel for the different sort of red flags to look out for. So my favourite red flag is the good old suspense account. How you can identify whether you've got anything in your suspense account is ask your finance person to prepare ask them to produce a trial balance as at a particular date. So let's say that 31 December, can you prepare me a trial balance as of that date? And basically your trial balance will list all of your account codes with the amounts against them for that point in time. So here's an example, and as you can see here, within the suspense account is normally sort of towards the bottom of the code of accounts, but it could be in other places. But that's what you're looking for, is a suspense account. The account code will vary from company to company, but it will be called suspense. And you ideally don't want to have any numbers, any amounts within this. It can legitimately be used in the year if people, for example, they get a supplier invoice, they want to process it to make sure that it's on the system so that it doesn't get forgotten about. But for whatever reason, they don't know where to code it. So instead of putting it to the correct accounting code, they will put it to the suspense account whilst they then find out where to put it. Personally, I don't like the use of a suspense account because I think it encourages laziness. You should just get it sorted sort of as and then. But there are legitimate sort of reasons for why you could use it. But if you end up with a figure such as this at the end of the year, you have a problem. Okay, so within the suspense account, obviously you'd need to ask your finance person to provide an analysis of the amount that makes up the 265k in this example, which is what we've obviously done. And we've discovered to our horror that we've got, purchase invoices in there of 150,000. We've got consulting costs of 15,000, insurance just over 5,000, IT support costs of 35,000, and legal expenses of 60,000. Now, I know this seems, a bit of an exaggeration, but there have been examples of, large amounts being sort of scribbled away into a suspense account and completely forgotten about until the end of the year. So as a result of this, we now have adjustments going through here with the purchases. All the things highlighted in yellow basically have come as a result of looking at that suspense account. And all of them have impacted the profit and loss account negatively, with adjustments amounting to the 260 odd K. So the next thing to look at is your aged debtors report, an aged debt report. It's also known as your aged receivables report as well. As you can see here, this is, I just want to highlight, this is a very simplistic report. I would expect there to be tens, hundreds of aged debtors in your own businesses, but obviously for simplicity here, I'm just demonstrating what one could look like and what really you're meant to be sort of looking out for. So the key thing here is looking at sort of debts that are older than 3 months, or even, if you've got things at 3 months, I would probably just sort of have a quick look at them. And you're sort of trying to identify whether you think there is an issue. So also you're looking to see if there are, a lot of negative balances. So, for example, the first one there, the Brighton Pier, actually you've got an amount of 25,780 or 760 that looks like it relates to the amount that's at 3 months. Now that just could be a sign of bad housekeeping. It could also be a sign that someone has said that the payment has been received on the system, but actually, it hasn't then been matched against the correct invoice or credit note's been raised. But regardless, if you've got a lot of positive and negative balances on your age debt report, then that is an indication. It's another sort of red flag that things aren't necessarily as in control as you'd like them to be. And in this particular example, we're saying that actually when we sort of analysed Fox's Bar and the Wilson periodicals, we actually discovered that Wilson periodicals had gone into receivership. So that there's the amount of 50,000 there, the whole amount there, we've decided is not going to be recoverable and is going to hit our profit and loss account. And likewise with Fox's Bar, the 23,000, actually we found that there's a dispute with that, and they're refusing to pay. So again, we're going to have to provide against that. So you can see the 73,000 is actually had to be written off as a bad debt expense in your profit and loss account. So that is impacting your P&L by the 73,000 because of those two amounts that are now not going to be recoverable from your customers, your two customers there. So the next thing to look for is depreciation. In smaller businesses, that aren't growing rapidly and investing a lot in assets, this probably isn't such a big thing to be worried about. But if you're sort of several million turnover and you're investing significantly in assets, then actually this does have a big impact on your P&L in the year. Quite often in smaller businesses it just gets done as an adjustment at the end of the year. But as I said, as you scale and you're investing more into assets, it is something that you should be doing. It's a monthly journal that happens, and you should be keeping on top of it, because it can have a significant impact on your profit and loss account. So you can see that actually in our original P&L, there wasn't any amount for depreciation. There wasn't actually anything in the budget either, which to me indicates that potentially the budget wasn't done particularly well in the first place. But the way you can identify whether there should be depreciation or not is asking for a copy of the fixed asset register. So the fixed asset register is a record that's kept outside of the sort of the double entry accounting system, and then the depreciation is accounted for through manual journals. The fixed asset register is good to take a look at, because it will give you an indication of sort of the amount of depreciation that is going to be required each month. And obviously, if you're investing significantly in assets, then depending on the accounting policies, depreciation policies for them, you will then have elements of the amount that they cost in the first place being put into the profit and loss account each year for their useful economic life. And that's basically when you invest in assets, they get held in your balance sheet, and then the amount that you've invested will then get depreciated into the P&L for the time that you expect to use them. So obviously, as you're growing as a business, you would expect to be investing significantly in assets, and therefore depreciation becomes more important in those sort of very much scaling businesses. So as you can see in this particular example, nothing was accounted for in the budget, so therefore it wasn't picked up in the original actuals. The way you would pick it up is by actually asking your finance people for the fixed asset register to take a look at that. And then things to look out for on the fixed asset register are, is there a movement in the brought forward accumulated depreciation and the carried forward accumulated depreciation, assuming that is not equal to the cost. If it's equal to the cost, basically that means that your asset has been fully written down, and there's no further depreciation to go through. However, if it's less than the cost, and it hasn't moved in the year, then you know that depreciation hasn't been charged. Also, if you end up with a cost that is less than your accumulated depreciation, which can happen, because, as I said, it sort of sits outside of the accounting system, that means that actually someone has over depreciated your assets. So there's it's quite a manual thing and subject to error, and it is worth sort of taking a look at, or at least asking for your finance person to show you, the fixed asset register, so you can sort of look out for those things that I've suggested. Anyway, in this particular example, we've discovered that we hadn't depreciated any of our assets, and as a result, we've got an adjustment to the profit and loss account, making our profit less in the year. So another thing that is worth asking your finance person to show you is the payroll control accounts. Now, this is quite a technical area. However, if you ask for the accounting transactions for each of the payroll control accounts, so these are accounts that are held in the balance sheet, and they're held there for a reason, because the payroll journals are manual. They should be done monthly, and they're probably the most complicated journals that you could do within an accounting system. And the payroll control accounts give you a really easy snapshot to see whether everything is in control or not. And the key thing that you're looking for here is whether each one of the control accounts goes down to zero soon after month end. So the payroll control accounts, basically they will be called something like wages or salaries. They will be pension payable, NI, or HMRC. They might combine the VAT one as well. It shouldn't, but sometimes they do. So they're kind of the key ones to take a look at, and I'll show you an example on the next slide. So here's an example of where you've requested, let's say for the last 6 months, the account transactions for the wages payable account. And here you can see that each month, where I've got it highlighted in grey, this should be at the end of each month. It should then be going down to zero, but you can see each month it's not going down to zero. So I can automatically see straight away that there is a problem with how the salaries, that the wages have been processed through the accounting system. What you should be seeing each month is basically a manual journal that takes the amount out of here, puts into the P&L, and everything goes down to zero. So because this isn't happening at the end of December, I can see that actually there's about £147,000 that has not gone into the profit and loss account. And as we'll see in a minute, this is then impacted on the P&L. So yeah, so here on our profit and loss account, you can see you've got the amounts there. Also, it turns out that the NI and the pension control accounts, they hadn't been processed either, because you could see that only 2 journals had happened in that 6-month period. And as a result of that, there have been 3 adjustments to the profit and loss account, making it less profitable than we thought at the start of this period. So hopefully from those examples, you can see that placing pure reliance on the profit and loss account in itself can be pretty dangerous, and that actually, having someone like a finance director or head of finance to come in and understand the wider context of your accounting system. Hopefully you can see the value of that in terms of keeping you sort of out of trouble. In terms of, I guess, the the importance of the wider context of having a finance director within your business. These could be summarised in the next couple of slides. So I guess, probably the most boring slide on here, but they can implement those controls to make sure that things like the depreciation not getting put through each month, or the payroll control accounts not getting reviewed and going back to zero. They can make sure that you have the right controls in place. Key control that I haven't yet mentioned is actually a bank reconciliation. You should be having a sort of an experienced finance person reviewing the bank. If you're on Xero or QuickBooks, you will have a bank feed. If you're on the likes of Sage, there's a bank reconciliation module within there. And the idea is that actually you don't end up with having a lot of reconciling items, a lot of things that haven't been accounted for in your accounting system. I mean, you could ask your finance person to produce each accounting system will produce a bank reconciliation report. You could ask them to do that if you're worried that isn't being done. And if they can't produce it, or if they produce a report that's got a lot of reconciling items on there and they're old items, then that would be a massive indicator that your accounting department isn't necessarily under control. As I mentioned, the other control accounts, they should be reconciled each month. So your payroll accounts going back down to zero, your supplier accounts. So, actually looking at your accounts payable, and again, sort of similar to what I said with the accounts receivable, you want to make sure that you haven't got loads of positive and negative balances on there, because it means that actually things aren't being matched off, or it could also mean that you've got duplicate invoices, etc. So you want to make sure that that's looking tidy and under control. A lot of businesses that we work with aren't using the accounting concept of accruals and prepayments, where basically these allow you to match your sort of income and expenditure, so they can become quite messy, and it does put an extra layer of complexity within your business, but if you aren't matching your income and expenditure, then actually it's very difficult to sort of work out the profitability of your business on a monthly basis. So a lot of the reports that you will then look at will be quite meaningless. So again, a finance director can come in and help you with making sure that things are being matched in the right period. Something else actually that going back to those bad debts that we had to write off, which impacted our profit and loss account, actually a very good control that a finance director could put in place is actually doing credit checks on new customers, to making sure that they're not a credit risk. One thing that actually you could do in addition to that, or potentially instead of it, if you haven't got the funds to do the credit checks each time, is it as a minimum to have a look at their company's house accounts. So all businesses obviously have to file, if they're limited company's house statutory accounts, and if you look at their their last returns, and see if they've got negative retained earnings. If they have, then that is an indicator that they're not maybe as liquid as you'd like them to be as a customer. That's kind of a good little trick to look at. So your finance director will also be able to provide insightful reporting. So as a minimum, I would suggest monthly management accounts. In smaller businesses, you can get away with quarterly, but assuming that we are sort of a scaling business of a couple of million plus turnover, then ideally monthly management accounts, where you are looking at your monthly figures versus prior year versus your budget. You're looking at year-to-date actuals, and then you've also got a forecast of the position for the business looking forward for the year as well, which could be based on your budget, assuming that you are sort of matching against your budget reasonably well. However, if things are way off the budget that you put together 6 months ago, then actually it would be worth doing a reforecast to then look at what the real picture is going to look like, and then that would actually then feed into your cash flow forecast, which then will give you an indication of if you need any funding requirements in the near future. Your finance director should also be able to work with you to identify what the key drivers are of the business, and help you put together a KPI dashboard which will have both sort of lead and lag indicators. So the lead indicators are ones where, for example, your pipeline in terms of work, that's a very good lead indicator. Number of inquiries, etc. To make sure that you're on track with hitting your numbers. Spoken about obviously cash flow forecasting, that age debt analysis. So each month, ideally, you want to be having a look at the sort of the old debts. Is there a problem, etc. Getting credit control on the case with with chasing up payment of old invoices, etc. Seeing if there's anything in the papers about any of your customers going into administration, etc. And then ideally, sort of looking at sort of profitability analysis. I'll give an example of this in a bit, but that is another example of where a finance director could sort of add some real value in terms of from a reporting perspective. I guess in summary, that your finance director is providing strategic financial oversight for your business. They'll be doing, as I said, sort of analysis that will help with decision making. They will be identifying inefficiencies within the business, and they will help you plan for growth. So just to give you a couple of examples of those. Here's an example of that profitability analysis piece that I spoke about. So this is courtesy of one of our fractional finance directors, Ramsey, who did a very, very good LinkedIn article on this, where basically he was saying that you can get a lot of information from actually having better chart of accounts, which provides more granular detail for your different service lines within the business. So just talking through example A here, you've got a very simplistic chart of accounts. So you've got all sales going to code 200, and you've got all cost of sales going to code 300. So at the end of the year, you can see that you've got £1 million has gone to your sales. So you've got turnover of 1 million, cost of sales 700k, gross profit 300k. So you know that your gross profit percentage is 30%. So that could be good. That could be sufficient information for you. However, if you've got a number of different service lines, then actually if it is possible to allocate the costs associated with those different service lines and splitting them out, it's far more valuable. So if we look at example B, where we've done this, you've then got different account codes, sales account codes for the 3 different service lines, A, B, and C. And then you've got 3 different account codes for their direct costs. So the cost of sales associated with those 3 service lines. And as you can see, if you look over on the right-hand side in terms of the profit or loss, for service line A, B, and C, you've then got the different costs allocated. You're going to have to do a bit of mental arithmetic here, but you can see that actually service line A, 600, it's got cost of sales of 320. So that is a profit of 280,000 that is contributing. Service line B, however, you've got sales of 200, but actually you can see that it's got costs of 220. So actually service line B, on the face of it, is losing you money, which is obviously not a good thing, unless obviously you've then got to look at the context of this. It could be that it's a new service, and you're investing more now, but it will be more profitable in the future. But nonetheless, you've got the ability then to have a look and sort of and further analyse. And then service line C is we've got 40,000 profit there. So on the face of it, your biggest sort of contributor to profit at the moment is service line A, and you need to do some further analysis of service line B to work out, is that an expected loss, or are there some surprises going on there, or do we need to think about actually discontinuing service line B? So in terms of identifying inefficiencies, one of the first things that a finance director will do when they come into the business is actually look at the budget and work out whether it's fit for purpose, and it will help them understand the costs that are being incurred by the business. If you remember going back to the profit and loss example that I showed earlier, there was clearly the budget wasn't correct in the first place, and I should also mention that most budgets, will not be 100% accurate, but if things like depreciation are being missed off, then there's got to be a problem. But what you will find is that when they sort of go into the detail of looking at all of the costs that make up the budget, they'll start asking questions. Why are we doing this? Why have we got this IT expenditure? Invariably, you will have different departments that have a certain amount of autonomy in terms of expenditure, and they will incur recurring costs that after a period of time will get forgotten about. So it's things like that will get looked at and scrutinized and worked out. Why are we paying for this software? No one is using it. In a particular example, again, that came from Ramsey, was he within one of his businesses, he looked at the for a particular supplier, they were being charged on the delivery costs were on a sort of a per unit basis, and as the company was growing, that cost was getting quite considerable. And he did some analysis and then compared that with other suppliers, and there were other suppliers that were happy to offer the delivery on a sort of a delivery basis rather than a per unit basis, and sort of taking into account the sort of the growing nature of the business, and then doing an analysis of that, he was able to save his client £120,000 a year just by switching suppliers and negotiating with the new supplier based on the sort of the growing rate of the company. So that was a sort of considerable saving that he was able to do sort of quite quickly at the start of his engagement with that particular client. And then I guess the final bit is that planning for growth piece. A lot of business owners, and I have alluded to this before in terms of just focusing on the profit and loss account, a lot of business owners think that the profit and loss account, as long as that is positive, is gospel. But as you grow as a business, you will end up having to use up more working capital, so you will have a requirement for more funds as you grow, especially if you don't keep controls of your stock and your aged your debtors accounts. So if you allow your aged debtors to your debtor days, so the number of days it takes for collection from your customers, if that figure grows over a period of time, you will then end up getting into cash flow problems, even if you are a profitable business. So this example here, you can see, so all finance directors should have the ability to put together financial forecasts for you with scenario modelling. So you change some of the variables and then you will be able to have a different sort of picture in terms of what that looks like. So this particular example, this is a business that is profitable each month, but this is actually showing you the cash flow requirements of the business going forward. So you can see here and all customer receipts for this particular business are on 30 days. And you can see that the funding requirement is, just here between January and February, there is a small funding requirement of 39,000, but then the business is cash positive ongoing after that point in time. If, however, you end up not being good with your credit control and your customers end up paying you rather than after 30 days, you end up with a situation where they're paying you on average after 90 days, then this is the sort of graph that you could end up having. And as you can see, the funding requirement now becomes significant. So your funding requirement now is, up in the right hand corner there, you can see 55k essentially, and this is purely due to you not getting the cash in from your customers at 30 days. You're doing it now at 90 days. So these sorts of models are the sorts of models that your finance director, could put together for you, so you can see the different sort of scenarios. Similarly, you could do sort of models based on projected growth of the business. If that's 20%, if it's just 5%. Looking at the anticipated increase in costs, etc., and then you can have sort of very clear sort of pictures in terms of what you're going to need from a cash flow perspective. And then I guess in terms of if you do then forecast that you're going to have funding requirements, actually your finance director is the person who will help you go and negotiate financing deals, whether that's with the bank or potentially looking at getting investment in from an investor through equity funding. And I guess that leads me on to my final sales pitch of today, which is a brand new service that Artemis Clark is launching, which is our financial health check. And essentially what we do is we get access to the reports that you are currently preparing, ideally to your sort of read-only access to your accounting system, your statutory filings, and obviously have conversations with yourself to sort of identify, we look at sort of 4 key pillars, which are basically the controls that you've got in place, the reporting, your compliance and your performance. And then we will provide you with the report, which, as you've seen here, with a summary of our findings, but also behind that is the sort of the detailed analysis. And then we have a sort of a list of our sort of recommendations, prioritised in order of performance. At the moment, as I said, a new service, we're offering it a bargain price of £950. To put that into context, each of our fractional finance directors, the day rate is, more often sort of above £1,000, and we are sort of spending in excess of a day or two preparing these reports, and then obviously feeding it back to you as well. So it is quite a bargain price at this point in time. So if you are interested in taking advantage of it whilst it is at the £950, then please do contact me either by emailing kate@artemisclark.co.uk or just contacting me via LinkedIn and send me a direct message on there. But yes, if you'd like to get in contact, also just let you know, just as a standard free service that we offer is our finance team diagnostic service. So that is you just having a chat with me, explaining your existing finance team, your growth plans, and I'm quite happy to just provide some free advice in terms of what I think that you need within your business. So that is also available as well. So thank you very much for listening, and if anyone's got any questions, then please do get in contact now.